In this video, we're going to continue where we left off. So we talked about the flow of inventory. When inventory is purchased, it goes to the balance sheet. And then when it's sold, it moves from the balance sheet as a current asset to the income statement as an expense. We talked about the two types of inventory systems. One is the perpetual system, which is what we're going to use in this course, and we're going to assume and you need to assume whenever we mention inventory that that's what we're using, compared to the periodic system, which is manual. This is updated in real time, and we'll see that when we do journal entries. And now we're going to talk about discounts, returns, and allowances. So one of the things is, if you are a seller, and you know the examples that I gave between Walmart, Target, and Barnes and Nobles, those are retail stores. So those stores sell directly to the consumer, right? Even Amazon. Amazon is a store that sells directly to the consumer. But most transactions are actually not between a company and a consumer. Most transactions are between a company and a company. So company A sells a bunch of stuff to company B. So Dell will sell to like Best Buy, and Dell will sell to Target, and Dell will sell to Walmart, right? Or Campbell Soup will sell to Target, and Campbell Soup will sell to Walmart, and Campbell Soup will sell to Best Buy. Well, not Best Buy, but Kroger, or whoever it is. So a lot of transactions happens between company to company, right? So one company sells to another company. And so we have this thing called discounts, returns, and allowances. So oftentimes when one company sells to another, the company company A sells to company B and says, hey, here's the items that you ordered, and I will give you 30 days to pay. So on January 1st, a sale is made, and then the other company has until 30 days to pay for the items that's purchased. So for example, if Dell sells, 1,000 computers to someone, right? They give them 30 days to pay for those 1,000 computers. Well, what that means is Dell now has to wait 30 days. The computers are gone, the inventory is gone, and Dell now has to wait 30 days for the customer to pay. So one of the things that companies do is they provide an incentive for for purchasers to pay early, and that is what is called a discount. And so a discount, you'll see this setup here. It's 2, 10, and 30, and this is the format that you'll see these discount terms in. You'll be 2, 10, and 30, and the first number you'll see down here is always the discount. So what this means, and you have to sort of understand what this means, is very simple, that the first number is the percentage discount. So this says you get a 2% discount. The second number is the number of days the buyer has to pay to receive the discount. So this says you get a 2% discount if you pay within 10 days. Otherwise, the full amount is due within 30 days. All right? So the first number is always the percentage discount. The second number is always the number of days you can get the discount. And then the last number is, if you don't take the discount, the full amount is due within that number of days. All right? So you need to become very familiar with how to read these terms for discounts. So we're going to practice just a little bit on these terms. So here we go. Here's another scenario: 5, 20, and 31. Again, the first number is always the percentage discount. The second number is always the number of days. And then the last number is, if you don't get the discount, this is how much days you have to pay. So if you read that, what does that mean? And you can pause the video and see if you can figure out what that means. But this means a 5% discount in 20 days, or the full amount due within 31 days. All right? Here's another scenario: 10, 50, and 100. So you should pause the video and see if you can read this before I give you the answer. So what is the answer for this? Well, this is a 10% discount if you pay within 50 days, or the full amount due within 100 days. All right, here's the next scenario: 1, 5, and 15. Pause the video and see if you can figure out what that means if you need the time. Okay, well, what is that? Well, it's a 1% discount if payment is made within 5 days, or full amount due within 15 days. Okay? And then the last one, scenario 4, 4, 20, and 49. Pause the video and see if you can figure out what that means. Well, this is a 4% discount if payment is made within 20 days, or the full amount due within 49 days. All right, so those are discount terms. Okay, so that's the discount, right? So again, 2, 10, and 30. This means that when a sale is made, you get a 2% discount if you pay within 10 days. Otherwise, the full amount is due within 30 days. So what that means is if I buy something, right, if I pay within 10 days, I get a 2% discount. And a 2% discount may not seem like a lot, but if you're buying millions and hundreds of $1,000,000 of worth of stuff from a customer or a vendor, then 2% discount actually turns out to be quite a bit, right? Then we have something called returns, and you're all familiar with this. You buy something at the store, you take it back at home, and then you realize, oh, this is not what I want, or maybe something is wrong with it, so you return it, right? So whenever a buyer buys something and then gives that back to the seller, then that is what we call a return of merchandise, right? And there are certain journal entries to do that, and we'll talk about those entries in a second. So what happens is when a seller receives a return, right, there's two things that happen. Those items that they received, that goes back into inventory, and then the sale has to be voided, right? So you don't have a sale anymore because those items have been returned back to you, and then what came out of inventory has to go back into inventory, and so we'll talk about those second. Something similar to return but different is an allowance. So an allowance is, let's say I ordered 15 orange t-shirts, right? And so you ship the order to me, and when I open them up, guess what? They're not orange, but they're green. Well, I'm gonna be upset. I call you up and I say, hey, I ordered orange t-shirts, but you gave me green t-shirts. Now you're in trouble because you've got these 15 green t-shirts, or how many ever I ordered, right? That was sent to me. Well, you don't have anyone who wants to buy green t-shirts. So what do? Instead of having me send them back, you say, hey, you know what, Okira, I'm so sorry. I gave you the wrong color. Look, why don't you keep those t-shirts and I just give it to you for 50% of the price? Now, I really wanted orange t-shirts, but if you cut the price down to 50%, can I be fine with the green t-shirts? Yeah, I probably can be. And so that's what an allowance is. An allowance is goods are damaged, or something is wrong with the goods that were received. So instead of returning the goods like we do in a return, the buyer actually returns the goods back to the seller. In an allowance, the buyer says, no, you keep the goods, the damaged goods or the messed up goods, and what I do is I reduce the price of the goods. I reduce the selling price of the goods to you. So instead of me paying full price, I get a 25% discount, or I get a 30% discount, or I get a 15% discount. So in an allowance, the buyer keeps the goods, they just get those goods at a discounted price due to either the goods being damaged or the goods not being exactly what they ordered, all right? So to recap, three things: discounts, you have to be able to read that. The first number is the percentage, the second number is the number of days, and then the last number is how much the full amount is due if you don't get the discount. So this is a 2% discount if paid within 10 days, the full amount due 30 days. Returns is if you buy something and then you decide to return it. And allowances, if you buy something and something is wrong with the items you bought, instead of returning it, you get a reduction in the price you pay for those goods.